To understand what's unusual or striking about Warren Buffett's most recent annual letter, it's important to understand the backdrop against which it's written. The broader stock market has been soaring to unprecedented heights in the lead up to Trump's newly introduced tariffs. Before these tariffs were implemented, the S&P 500 had price-to-earnings ratios of 28, which is significantly higher than historical norms. This elevated PE ratio is a major indicator that the market valuations had reached overheated levels. One of the tools Buffett uses to assess whether the market is overvalued is the so-called Buffett indicator. The indicator compares the total market cap of all U.S. publicly traded stocks to the GDP. It's a straightforward but powerful gauge. Before Trump's tariffs were rolled out, the Buffett indicator had climbed to an astonishing 188%. To put this into perspective, during the height of the dot-com bubble, it peaked around 140. And just around the financial meltdown of '08, it was around 105. This means that just before the tariffs, the indicator was flashing warning signs. In fact, the reading of 191% places it in extreme danger territory. Buffett's own actions in recent months seem to support the idea that he's deeply concerned about current market conditions. By December 2024, Berkshire Hathaway was sitting on a massive cash reserve of $334 billion. That's nearly double what had been held in December 2023, showing a 99% year-over-year increase. The dramatic rise in cash reserves didn't happen by accident. A significant contributor to this cash pile was Buffett's decision to offload a substantial portion of his holdings in Apple, the company that had long been his single largest equity position. Over the course of 2024, Buffett sold more than 600 million shares of Apple, leaving him with the remaining 300 million shares. This brings us to a question. Why would Buffett reduce his stakes in Apple so drastically, especially when he's repeatedly expressed strong confidence in the company? The answer lies in Buffett's own philosophy, which he shared many times in interviews, letters, and lectures. In one particularly insightful discussion, he outlines three major reasons. First and foremost is the element of greed in the market. According to Buffett, many investors tend to act emotionally rather than rationally. When markets are performing well, they look at recent gains and assume that good times will continue indefinitely. This overconfidence leads them to pour out even more money into stocks, often leveraging themselves by borrowing in hopes of magnified returns. Buffett calls this behavior rear-view mirror investing, making decisions based on past results. People tend to get caught up on what their neighbors are doing too. If someone missed out on last year's rally but saw their less than savvy friends making big gains, they often rush in too late, driven by FOMO. This collective behavior drives prices higher. The market becomes irrationally exuberant, and as Buffett puts it, people become greedy when others are greedy, just as they're fearful when others panic. His message is clear. Maintaining objectivity and resisting herd mentality is critical. Buffett has lived through major cycles of boom and bust in the market. He recalls how in 1979 he wrote a piece for Forbes lamenting the fact that pension funds had stopped investing heavily in stocks just when they had become attractively priced. In the 70s, when stock prices were low and yields were high, pension funds pulled back. In contrast, earlier in the decade, when stocks were expensive, they were all in. This irrational behavior underscores a key point. Humans, being emotional creatures, often buy and sell low, the exact opposite of what successful investors do. Buffett offers a historical example that drives this point home. When he was a young man, stocks were trading at just 2 times earnings, and yet investors avoided them. Even people with direct interest in the success of these companies, like employees or sales agents, refused to buy the stock, even though it was offering returns up to 35%. This disconnect between reality and perception was shocking to Buffett then, and similar disconnects still happen today. The same pattern of behaviors repeat across decades. This leads to Buffett's second reason for reducing stock exposure, earning yields versus interest rates. The earning yield is the inverse of the PE ratio. With the S&P 500's PE ratio at 28 before tariffs, the earning yield works out to around 3.57%. This means that for every dollar invested, you'd expect to earn about 3.57 cents annually in profits from those stocks. Now compare that with what you get from simply parking your money in 3-month U.S. Treasury bills, which were yielding about 4.3% at the time. These are government-backed securities with virtually no risk, offering higher returns than the stock market. It's a no-brainer. Why would any rational investor choose to take on stock market risk for lower return? Buffett recognizes this mismatch and is therefore parking more of Berkshire's capital in short-term Treasury instruments. It's a temporary measure, driven not by a belief in bonds as a superior long-term investment, but by the current imbalance between risk and reward. Buffett once described a similar choice he faced early in his career. He could either invest in a solid insurance company offering earning yields of 35% or stick with government bonds yielding just 2%. The better choice was obvious then, just as it is now. Only now, the roles are reversed. Today, bonds are yielding more than stocks, which is why Buffett is favoring them in the short run. The third and final reason Buffett is raising cash is sustainability. How realistic is it to assume that stock prices can continue to climb when they're already so high? Let's imagine the market rose another 50% from where it was before the tariffs. What would it be due to the valuations? If prices rise by 50% and earnings remain constant, the PE ratio would skyrocket to around 42.85. This equates to an earning yield of just 2.3%. Why would you feel comfortable in investing in the stock market for an expected return of 2.3%, especially when you can get 4.3% with a treasury bill? This hypothetical shows that there's very little room for prices to go higher in a sustainable way without earnings also rising significantly, something Buffett doesn't expect in the near term. Now that we've laid out Buffett's reasoning, let's take a closer look at his 2024 annual letter to shareholders. In it, he says that the Berkshire performed better than expected during that year, even though 53% of the company's 189 operating subsidiaries reported lower earnings. The main reason for Berkshire's overall earning growth was a sharp rise in investment income, driven by higher Treasury bill yields and an increased allocation to these short-term, highly liquid instruments. Buffett emphasizes Berkshire's operating earnings over the traditional GAAP accounting numbers. Operating earnings strip out the often volatile capital gains or losses from the stock portfolio. While GAAP earnings can fluctuate dramatically from year to year, operating earnings give a clear picture of how the company's core businesses are performing. Buffett reminds readers that although Berkshire's cash position might be outsized, the company still has the majority of its capital invested in equities. However, marketable equity holdings fell from $354 billion to $272 billion in 2024, even as Berkshire's investments in privately held businesses increased. This confirms what we already know. Buffett is pulling back from public equities, likely due to concerns over valuation. Importantly, Buffett reassures investors that this shift into cash and bonds is temporary. He reiterates that he will always prefer owning good businesses over holding cash or fixed income instruments. He also warns that paper currency can lose value over time if governments behave irresponsibly. This is why he ultimately places more faith in real businesses, especially American businesses, than in cash or bonds. Still, during periods like the one we're currently experiencing, Buffett is happy to wait patiently with cash and short-term bonds until better opportunities arise. So, what can we conclude? Buffett's 2024 letter is a subtle but powerful signal to investors. He isn't abandoning the stock market. Far from it. He continues to believe in the long-term value of equities, particularly American ones. But right now, the combination of excessive market greed, low earnings yields, and sustainable valuations has led him to reduce his stock exposure and pile up cash. This isn't the first time he's done this, though. During previous market bubbles and crashes, like the dot-com era or the 2008 financial crisis, Buffett kept his cool and made big bets when everyone else was panicking. History suggests he's preparing to do the same again. The stage is being set for a major correction, and Buffett, as always, is waiting patiently for the right opportunity. If you found this analysis insightful, give it a like and consider subscribing for more breakdowns like this one. Until next time.